Brian, let's talk about the top plays within the sector, because I think declining demand for EVs, that was one of the overall narratives that came out of this past earnings season. Is some of those fears, is that overblown at this point?
Well, I think we have a situation where the pace of innovation has, in many ways, moved faster than the expected adoption curves for these technologies, particularly on the electric vehicle side. So, automakers find themselves asking critical questions about their development. I think that the electric vehicle future is an inevitability. I think the question has really become it's a matter of when, and that when keeps getting pushed out. And that's something that we've always felt here. A lot of the excitement, a lot of the enthusiasm for electric vehicles is really centered on early adopters to start. Some of the use cases I think that are coming forward that are really exciting aren't necessarily in the traditional light vehicle market. But as we kind of look forward, I think we're fairly excited about what's going on in the internal combustion engine portion of the market, and really kind of the push out of what that means for the broader ecosystem. So, we are seeing growth in electric vehicles, just at a slower pace than would otherwise have been expected.
So Brian, Pras here. So talking about the big three in particular, you note that the adoption curve hasn't really happened as much as they would like it to, or they're deeper as much as they want it to. What did they get wrong here, and what can they actually do to kind of course correct and make them better plays?
I don't necessarily know that they've done anything wrong per se. They needed to have the products ready to go. The fact of the matter is that we're in this period now where tens of billions of dollars are really being spent on an annual basis by the big three towards electric vehicle production, and it's coming at with an uncertain outcome as far as if those vehicles will be adopted and when. But the reality is they need to be there. They need to be there from a customer standpoint eventually, but they also, from a government standpoint, need to have invested this capital to right size their own vehicle framework over the course of the next decade. What we're going to see, though, and this has really kind of borne itself out, whether it's GM, whether it's Ford, and whether it's Tesla, is that the CapEx is going to be high, cash flow is going to be lower, and the margins are going to be lower than they would have otherwise thought. So that's the reality of the situation right now for the automakers. It's created some nice opportunities elsewhere in the automotive ecosystem, but right now it's a relatively difficult time from a last 15 years basis for the traditional automakers.
So during that relatively difficult time, one of the areas, at least within your portfolio and investment thesis here, it really leans into predictable resiliency. Where does that lead you to in terms of specific names?
Sure. So for the better part of 45 years, our firm, led by Gabelli, has followed the auto industry. We've held a conference in Las Vegas showcasing the automotive aftermarket. So there's about 285 million cars on the road in the U.S. That compares to the 16 or 17 million that gets sold from a new vehicle basis. So, we really think in terms of the life cycle of a vehicle. It's taken us to great places, great investments like Genuine Parts over the course of the last 45 years, O'Reilly, et cetera. But we like the dealer space, specifically a company like an AutoNation. That's the second largest dealer group in the U.S., ticker's AN there. It is a business that is growing its after sales, or its parts and service business, by low double digits, while it services the vehicles that it sells over the course of the last few years that are becoming more complex. Everything from active safety to advanced propulsion to infotainment systems. These are becoming more difficult for the traditional aftermarket to fix. So a company like AutoNation, which will still sell through traditional dealerships new vehicles and used, is really taking advantage of what is the profit center of that dealership group to really grow that parts and service business, drive free cash flow, expand the business, and ultimately buy back quite a bit of its own stock in the process.
So Brian, looking at broadening out the big automakers, right? As a value investor that Gabelli Funds focuses on, when do the automakers look interesting for you guys as an investment? It's
a really good question. Automakers traditionally have been cheap from a statistical standpoint, we're really looking for what the catalysts can be for these stocks over the course of the next 5 to 10 years. I think you have to look in terms of initially price, and it's hard to say that GM at 5 times earnings or Ford at 6 times earnings is expensive. But the real question, as a value investor, you have to ask yourself is when do you just say it's cheap for a reason? And I think I'm not ready to say that exactly, but I think given the amount of capital investment that needs to come into these industries over the course of the next 5 years, given the lower margins we're going to see, Ford, to their credit, is showing the amount of investment and negative income that comes from the Ford E movement. I think it's difficult as a value investor to really say right now that this is the right time. The shares are going to take a 20% dip, then that might change just from a trading perspective. But we are really looking for catalysts in stocks, and it's hard to see that right now for the traditional automakers.
So should investors be buying the dip per se in Tesla at this juncture?
Tesla's a really interesting situation. Again, we are a value investing community at Gabelli, and you're talking about a company that you really need to have confidence that there is a piece of the Tesla story that goes well beyond traditional automaking. Stock is going to earn somewhere between $3 and $3.50 or $4 for this coming year. And if you're thinking about a stock trading just below $200, what are you going to be paying 45 or 50 times earnings for? Is it for a decelerating top line in its traditional auto business? Is it for the potential down the road for there to be robo-taxis? Is it for AI? While Tesla shares have declined over the course of the last year or so, we're not necessarily ready to say that it is a value stock. It's certainly become more interesting at these levels than it has been in some time. And I do think that, for a company that is going to be the leader in electric vehicle development over the course of the next decade, there are some really exciting things going on, but can't definitively say that there's a price that I'm loving diving into to Tesla unless I really believe that there is an AI story here that I want to invest in.
Yeah, well, certainly here, when that excitement turns into earnings and realization there is what a lot of investors are going to be trying to. Yeah, exactly. 2 different things there. Brian Sponheimer, who is the Gabelli Funds portfolio manager, and our own Pras Subramanian. Thanks so much for the conversation. Appreciate it.
I thank you very much for having me.
Certainly.